cloth.
Excellent. Okay, thanks. Okay, thank you very much. Thank you very much for coming in for this, I think, which will be a very, very exciting session. My name is Rajul Awasthi. I'm not Arturo Herrera. Arturo is here. He will deliver opening remarks, but I'll moderate the session. I'm a lead governance specialist in the governance global practice, and also co-lead the Global Solutions Group on tax administration. So the way we're going to do this is we'll have Arturo deliver some opening remarks, and then we have 3 speakers who are here in person, and we have Arthur who you can already see on the screen there, who will join us online. I will request presenters to restrict their speaking remarks to between 15 to 17 minutes. And what we will try to do is to have 2 or 3 questions right after each paper is presented. So they are diverse papers, and they are on quite interesting but slightly different topics. So we will try to wrap up in the 2 hours. So without any further ado, let me introduce Arturo Herrera. He's a global director for the governance global practice in the World Bank. Arturo has had a distinguished career in public service, having worked in Mexico, not only as the finance secretary for the Mexico City administration, which I'm sure he will refer to in his remarks today, but also as the deputy and then the finance minister of Mexico. So, Arturo, over to you.
Yes. Thank you. Thank you. Really happy to be here, and a little bit of an apology because I'm just going to be staying for an hour. I need to catch a plane. Indeed, I was a Minister of Finance of Mexico, but more important for this particular seminar is I was Secretary of Finance of Mexico City. And why is that more important? Is because when I had that responsibility, I was actually running the property tax department of Mexico City. So issues related to property tax are very close to my professional development. Property tax are incredibly important and are taking a more and more relevance in the development agenda. We recently a draft memorandum between the IMF, which is over here, the IMF, and also was circulated. And one relevant aspect is related to property tax. And why is this so relevant? And that poses a couple of challenges. Well, if we look to OECD tax collection on property taxes between 1.8 and 1.9% of GDP, and 2 of the examples that we are going to be discussing today are for advanced economies, and 2 other examples are for developing countries. In developing countries, the tax collection is between 0.3 and 0.6% of GDP. So that gives you an idea of the opportunity, if you want to look it on, of the challenge. I wasn't sure of that number, so we just calculated for Mexico City before coming here. I did end up being exactly 0.5, which is at the higher end of local governments in Mexico. Now let me share with you a few reflections about this. When you look to tax collection administrations in a country, by definition, the most sophisticated one is the national tax administration. But the taxes that a national administration collect are mostly flow-based. The value-added tax, the corporate income tax, the personal income tax. The property income tax, which is the property tax, the real estate tax, which is collected by the local government, is an asset-based tax. And as such, it requires evaluation before it. So we got some sort of a contradiction in the sense that the easier to collect, at least theoretically, taxes, which are the flow-based, are collected by the most sophisticated agencies, and the most difficult to collect, which are the asset-based, are collected by the less sophisticated, which are the local entities. So that's the first problem. So once, and the first issue there is an issue of valuation, and how to determine the value of an asset. For the last 30 years, there have been a series of reforms in developing countries which are equating at the legal level the property values for tax purposes to commercial values, right? Now, that in principle is easy, but it's easier said to done. whenever I refer to this, I always think to the house I grew up. So that's where my mom still lives. And that was bought by my great-grandfather in, I think, in 1920. So the last market transaction on that house was 104 years ago. And it's probably not very dissimilar to the neighborhood in which my family still lives. So the question is, how do we approximate values for commercial values or market values for goods that are actually not in the market, or like in the case of my mom's house, had not been in the market for 100 years. So there's a need to do an assessment of that, and that's what the first paper deals with. Now, there are basically two broad legal traditions in the world. The common law tradition, which is followed here and in Anglo countries, in which the ways to operate are a little bit more flexible, and the civil tradition, the civil law tradition, which requires very specific guidelines in terms of how to operate. So the first paper is about the biases that could happen in assessments in a common law framework. Now, that doesn't mean that in the civil law framework don't exist bias. So let me tell you one example. This is actually the invoice for my apartment in Mexico City. And as I was preparing my notes this morning, it happened to be there, and I'll pick it up. So let me tell you what is the assessment. So in a civil law tradition, you require very specific guidelines to do it so that there's no subjectivity in theory about the assessment official, which is what the paper is about. So it will try to come with objective things like, what is the price of the land in this neighborhood? What is the cost by meter to building something in this neighborhood? And then something very obvious is, well, it's not the same value that a house that was built today have as opposed if it was built 10 years ago. So then you impute a depreciation rate, right? Now let me tell you a little bit about my apartment. It was the first piece I bought in my life, that's why, despite not living in Mexico for a long time, I still have it. It's a beautiful apartment, right? It's an Art Deco apartment. It's actually protected by the Fine Arts Institute in Mexico. But that should tell you two pieces of things, because they don't protect unless it's something that was built last year. So this was built in 1936, I guess. Now, if you apply a depreciation rate over 80-something years to a value, it got a really low base. Now, it's in a very nice neighborhood, so the actual commercial value has been growing up at the same that the fiscal valuation has been going down. So for this year, I'm paying 581 pesos, which at today's current exchange rate is $34 per year. And you could actually pay every 2 months, so that will be $4 per month. So when I went back to Mexico and we were going to have family, we decided to buy another apartment, which has basically the same valuation, commercial-wise, in the same neighborhood. It's actually just 5 blocks, or no, actually 3 blocks from where it is, and it pays 20 times more in property tax. So biases in the valuation for property tax do not only occur on common law environments. It could occur actually in more dramatic settings in Bourbonic traditions. Now, the second paper, which Rachel is gonna, it puts together two taxes that could go. The tax on transactions, on selling of houses, versus a tax on property tax. And that correctly, and I'm not gonna deliver her paper. So that correctly point out to potential biases in the rent to price in the rent to own market. Two actual comments. The first one is going back to the civil law tradition, and recognize that this construction will be biased. Another way that has been tried to actually assess the value is to use the rent to price ratio, which we will learn in your paper. It could be also biased. Now, one question that I got about it is, yes, a high transaction tax could be biased the market towards owning versus, towards owning it. But in many countries, that actually has been a policy, right? Even here, if you think that given that most of the houses are bought with a mortgage, the two large sponsor entities, Fannie Mae and Freddie Mac, were developed with that view. It was not necessarily just left out to the market, but there was some sort of bias into the decision. It was perceived that, wrongly or right, that the public interest was to promote ownership of a home. And then we will have two really interesting papers on developing countries. One which is probably on the opposite side of the spectrum of the first one. The first one, you assume that people are actually paying that taxes and that there may be a bias. On the third paper, we are going to see that people, the tax is not paid. They may not even be in the database. So how do you work? How do you work on that one? And probably halfway there, it's going to be the example of Brazil. And there's a huge question, which is probably brings me back to the issue that I was starting first to do it. Property tax are local government taxes. But local governments could be the city of New York with 8 million people, really sophisticated, or it could be a 10,000 city in Tanzania with exactly the same kind of responsibilities. So how to deal with that? Some people have been thinking on a re-centralization or decentralization in order to allow a third party to do the evaluation, despite the fact that the tax is owned by it. So let me just finish my remarks with one final comment, which I thought it was really important to do here, which is property tax are very important for some other reasons. It's a progressive tax, but it's also very smart tax for the city, because the services that a city typically do, like garbage collection, potholing, covering the potholes, security, etc., are somehow proportional to the number of houses that it has, right? And with the exception of the US, that's mostly how it works everywhere. Now, city capitals tend to have two problems. One is that government buildings are exempted of taxes, and international embassies are exempted to taxes. And that, as a general rule, is not a problem because there are a limited number of the houses in a city. That would be a problem, a huge problem, only in the hypothetical case in which you have relatively few houses, very large government, and multiple international locations. That's the case of Washington, and that's actually the case of this building, which is property tax exempted, as well as the IMF, as well as the White House. So this is one of the very few examples in which you have a structural deficit in a city because of the way in which the property tax is designed. So let me stop here.
Thank you so much, Arturo. Thanks. Really, really interesting. And I think your personal experiences that you shared are extremely illuminating and insightful. So I think let's just get straight into the paper presentations. There are very, very interesting papers, but let me not stand between Carlos and you. So as I said, try to restrict it to 15, 17 minutes, and then we can have some questions. Thank you so much.
Organizers for the invitation. So this is work with True Power. It's a University of Utah. And here what we're exploring here is the racial inequalities that arise in property taxation because, as Arturo was mentioning, we have these challenges in the way we value our properties. Let me make sure I keep in the time. So let's start directly how we can have this problem. If we can think, for example, about a sales tax is a relatively easy tax. You go to a store, you just make a purchase, you put a tax directly on it. When you make the sale, you know the market value of your purchase. We don't have that with properties. Again, if you have a property that hasn't been sold in 100 years, there will be a large divergence between the last market transaction and the real value of the property. In the U.S., this also had to be the case, and historically it's not necessarily the case. In the U.S., the taxes is levied on the market value of the property, not on the cost of the structure or other forms of doing the valuation. And there's a lot of historical reason why this is so, but for most of the recent history in the U.S., that's the case. So the challenge here is how we compute an assessment in a way that is both representative of the real market value of the property and in a way that is equitable across many characteristics. So let me describe a little bit how this works. So again, if you have two people, and we're thinking, again, the goal is having equitability in the property taxation. If you have two people that are subject to the same tax rate, and both of them have the same, they have properties over market value that is observable, then the property taxes should be the same. Basically, the total property tax, the effective tax, will be the policy rate, which is the tax that is fixed, times the market value of the property divided by the market value of the property. And that sounds tautological, but that's how it should be. That should be the tax rate. And for two people that have two different market values, you will have the same tax rate. But again, since we cannot observe that, this tax bill is not going to be what you are actually observing. In reality, what you're going to be observing is this. You're going to be observing that the actual effective tax will be the policy tax rate that is written in paper times the assessment divided over the market value of the property. So again, if you have an assessment that is differs from the market value in ways that are proportional for every two individuals in any dimension we can look at, then the market, the property tax will be implemented equitably because the effective tax rate will be just this function between the assessment ratio and the policy rate, but as long as the assessment ratio is held consistently across everybody, you won't have a problem. Again, to repeat, to just make sure we are in the same terms, the assessment ratio is going to be that assessment relative to the market value. That's going to be the way we are going to adjust the tax rate to actually, the policy tax rate to actually get the effective tax rate. But what happens when you don't have the same assessment ratio? Even if you hold the policy tax rate fixed, there's no difference across people, you will have a problem. You have a problem because you are overtaxing because you are making valuations that are dissimilar across different groups of people or different properties. So the objective of this study that I'm showing here right now is we're going to look in what we call taxing jurisdiction in places where the services provided and the intended taxation is supposed to be held constant. We're going to explore what the variation in the assessment ratio is and how that affects inequality, particularly racial inequality. So just I'd like to give visuals so that we can look a little bit this before going to the data. So this is Philadelphia, and we have in the left-hand side we have the realized assessment ratio. So here we're taking the market value of a lot of transactions of properties and seeing their assessment at the price at the moment that they are being sold. And then we see for this heat map, and we see that in the central part of Philadelphia, there's a higher assessment ratio. The value of the assessment is higher relative to the market value than they are in other areas, like a little bit like the southeast of Philadelphia. And if you start comparing this with a map of the amount of residents, the black share, the minority residents that are in Philadelphia, you see that this basically overlaps correlates very clearly. So this is a problem. It's clearly you can see in Philadelphia. And this is not specific to Philadelphia. We can do this for every city. This is another city. This is Cook County. This is for Chicago. Chicago is. We have the same situation. The assessment ratios are way higher exactly where the minorities are. So what I'm going to be doing in the rest of the presentation is we're going to be quantifying that. But just to give you a preview of what we actually document, we show that this gap is about 10 to 13% higher for Black and Hispanics homeowners. So, and this is, again, within tax jurisdiction, which what this I mean is we are holding intended public good provision and taxation constant. And this is a lot. This is $300 to $390 a year for a minority homeowner in many of these areas. This is a lot of money. It makes the difference between being evicted in some cases and not. This has large implications. And at the 90th percentile, this can be as much as $800 annually. After we document that, we decompose this gap into two channels to try to figure out why this is happening. So we document two main channels. We call the first channel the spatial or between neighborhoods component. By this, we mean if you live in a large minority neighborhood, regardless of your race, you can be a Caucasian person living in a high Black shared neighborhood, you will be paying 6 to 7% more on taxes. So that's because you live in the neighborhood. That's a tax for the neighborhood itself. And then you have a 5 to 6% that is an individual. It's within neighborhood individual component. So that means if you're a Black person, even if you are living in a white neighborhood, you will be paying higher tax. So we have this problem. And again, if you're a minority person in a minority neighborhood, you will be in the worst situation where you will be paying to 10 to 13% tax rate. So those are the components we're going to be digging into. And if I have time, I don't know if I will, but this is, I was talking to a few folks here before we started. This is relatively easy to correct because the problem mostly arises from misvaluation. It's problems with the methodology. So shouldn't be hard to correct, and we showed that a simple algorithm can correct most of this inequality. So before I talk a little bit about how we do the measurement, just fixing a little bit some definitions, we're going to make this analysis within what we call a taxing jurisdiction. And the taxing jurisdiction will be the overlap of every potential public good providing and taxing entity in a location. So basically, if you, for example, have a county, the county can levy a tax, provide some public good services, but so does the city inside the county, so does the school district inside the county. If you have utility districts, they also do the same thing. So in order to actually be able to compare these neighborhoods, we want to make sure we're holding all of this constant. So we're going to be comparing within jurisdiction. We're going to be comparing these two homes against each other, these two homes. We are not going to be comparing across in order to make sure that everything is held fixed. And once we have that, then we have everything we need for our estimated equation. We're going to look at the assessment ratio on the left-hand side. We're going to be controlling, these are fixed effects for each of those taxing jurisdictions, and we are going to do those fixed effects cross time, so with jurisdiction time, because we know that the way the public good provision and also tax implementation changes over time. There's difference in practices. And then we will have our coefficient of interest, which will be beta, times the raise of the homeowner of the property. And if we have equitable taxation, then the null here is that this beta should be 0. This should be relevant for the way we are seeing this. Again, now this has some legal grounding beyond just being able to document it. The standard of the law right now in the U.S. is disparate impact in housing. So if you have a practice that has discriminatory effect, that is sufficient for a finding of discrimination in the context of housing. Of course, there's a little bit more legal nuances to that. You still need to show what is called a causal requirement that is lower than intentional discrimination, but it requires that there's a linkage between the practices and the discrimination, but that's a little bit what this paper actually provides. So this is an important legal context. So why do we find here? So this is the main result that we find before the composition is that for black residents, they will be paying about 13% more in a higher, 13% higher assessment. And if you include Hispanics, actually that is around 10%. If we break it by states, there's a lot of heterogeneity by states. In some places like Indiana and Texas that you wouldn't expect typically from the priors of many folks I've talked to, they actually do pretty well in the way they implemented taxes. In other places like Illinois perform very poorly. Reasons behind this heterogeneity, a lot of it is the implementation of the tax system. For example, property taxes are very important in Texas. So they have implemented a lot of oversight systems that make sure that you have more equitability across many dimensions that eventually spill over to race in the state. In other states like Illinois lack those controls. So we have plenty of heterogeneity across the state. We also have heterogeneity, I haven't spoke about that yet, but we will have heterogeneity also behind the decomposition of the channels. For example, in DC, we know most of the effect of the inequality that we have in taxes in DC actually comes from the individual channel rather than from a neighborhood component. This is also another way of seeing this. This effect is larger for areas where you have low income. So if you can think about it, this may be reflecting a little bit of problems with taxation that are actually affecting more low-income folks, which also are affected by this problem. Even within low-income areas, the inequality across race is larger. And here we are just seeing another way of seeing this. You can look, for example, in this axis over here, you have low minority neighborhoods to high minority, you have low value homes and high value homes. And what you see here is that in areas where the value of the homes are the lowest, and you have the highest amount of the highest minority share, you have even a higher taxation. In this case, even reaches over 40% difference in the gap. So it's really, really concentrated in places where have a lot of minorities, where there's low income, and where there's very low home values. That's really, really skewed. In the other extreme, if you have a high value home in a low minority neighborhood, this is almost zero. All right, so now I just told you the main results. We have a large assessment gap. In addition to have a large assessment gap, we also have that is because of race and because of income or value. So the last thing I want to talk about before, because I think I'm running out of time, is I want to decompose this into what are the channels that are driving this. So I want to say there's two channels. We want to say the neighborhood composition effect and the homeowner effect. And this is important. The neighborhood represents a problem with valuation. It means that there's a systematic way in which assessors are not pricing these properties. And the homeowner will have to do with other reasons that I will talk about in a few minutes. So the ideal experiment is to take two homes that are close to each other and see if there's difference in taxation. So how are we going to do that? We're going to take a whole jurisdiction and start having successively smaller geographical areas and see how the tax changes. So when we go to the tract level and then to the block level, you start seeing that there's a reduction in that effect. And that part that remains is what we call the within effect. It's even if you are very close together and you have a person that is a minority homeowner and somebody who's not, that minority homeowner is going to be paying 5 to 6% more. And the rest is going to be a neighborhood component. 6 to 7% of the gap is for neighborhood reasons. This is important. Again, I was talking about the causality requirement. If you have problems with valuations, which is this neighborhood component, there's a link between the inequality and a particular government procedure that is leading to discrimination. So this, if there's lawyers in the crowd, this matters for having those cases. So showing something, these neighborhoods do look different in many characteristics. Clearly minority by construction, but also unemployment, benefits, SNAP benefits, homeownership percentage. And we can use those characteristics that are different to try to see how those affect the values of the home and the assessment of the home. And the general idea is the following, is if you take the value of a home, it should be a decomposition of two things. It should be a decomposition of how much structural characteristics of the home, square footage, like the total amount of bathrooms and bedrooms, affect the value of the home, and how much neighborhood characteristics affect the value of the home. That's basically, you live in a nice area, that should be affect the value of the home. And then we will look at it, how that affects both the assessment and the market value. And if they are the same, there's no problem. There's no inequality. It means like the assessors are tracking well the market values. If they differ, it means that there's actually not a good tracking. And what we find is assessors are pretty good at valuing structural characteristics. So you say like fireplace, pool, patio, square footage, bathrooms. The difference between these two are very small. It's close to zero. But if you start seeing non-structural characteristics, neighborhood characteristics, the differences are huge. They systematically do not track well the market values when you look at neighborhood characteristics. And that's the reason why you have the other part. So I think I run out of time, but the only thing I want to say is we also have 5 to 6% that comes from within the homeowner, and we look at other reasons why is that. We look at appeals data, for example. Appeals individual specific, and we show that homeowners, individual homeowners, are less likely to appeal a tax to begin with. If they appeal, they are less likely to win. And they win, they are less likely to get a reduction. And all of this is by large margins. If they get a reduction, it will be 25% less than a white homeowners. And if we have time, I can tell you outside why this is so. There's a lot of reasons why this is happening, but this affects a lot this effect. So just takeaways. There's 10 to 13% property tax burden. There's a geographic channel and a homeowner channel. And the geographic channel is very important if you're thinking about the law of this, how to implement FHA, disparate impact standard. And this inequality actually can be corrected fairly easily, except for political roadblocks that we can talk about in another time. Right, thank you.
Thank you very much, Carlos. Carlos, as you might have seen in your papers, is an assistant professor of finance at the University of California, San Diego, and his research agenda focuses on the relationship between political and financial institutions and economic redistribution. So we have 7 minutes for questions. The floor is open, please. One there. I think I'm. Okay, I'm going to go with Taiwo Oyebola there, and then I'll come to you. And then I think that's pretty much what we'll have time for.
Thank you very much. That's an excellent research. Just out of interest, because a lot of the analysis and your conclusion, it's on the basis of someone that's representing government doing the assessment. Is there any case for simplifying the process for assessment such that government can define the parameters objectively, maybe without human intervention, and property owners can then do a self-assessment and pay the taxes?
Yeah, that's a good question. I did intend to say this was mostly human-driven because in practice in the US, it is not, especially for larger cities. If you go to some smaller cities, I talk with some smaller cities in Indiana, and some of them do make pen and paper type of stuff, but that's not the convention in most places. I talk a lot with people in Chicago, I talk to a lot of people in Atlanta, and these processes are mostly automatized. In some states, it is explicitly forbidden by law to have someone go in there precisely to avoid discrimination. So that 6 to 7%, the first part, is not mostly driven by a bias on the assessor themselves. It's really a problem of the techniques, which they do have a history of embedded discrimination. Andrew Carroll, a historian, has a lot of work showing that. It has been baked in, and it's interacting a lot with the legacy of segregation that we have in the US. Actually, in the paper, the longer paper, I do have analysis that show wherever you have more segregation and other problems, these effects are actually larger. So it's not exactly that. But the problem a little bit is the techniques that they have are not refined enough. A lot of these standards are based on standards from the 1970s. They are not refined enough to the amount of data that we have now to actually collect the price as well. So what generally happens? Since we have like a large problem of segregation in the US, you will have in, say, for example, in San Diego, where I live, you have white folks buying the homes in front of the ocean with the amazing views. You have like minority folks living in areas that are like in least desirable locations because you have industrial pollution. You have like some areas like that are too commercial. Nobody wants to live close to those areas. The market puts a premium to the ocean view and puts a penalty to having those industrial exposure close by, but the assessor doesn't account for that. So basically, you are just rewarding, because you can have a two-bedroom apartment in Manhattan and a two-bedroom apartment in, I don't know, somewhere in St. Louis that doesn't, they're exactly the same square footage, everything is the same, but they don't have the same market valuation because all these neighborhood attributes are not accounted for. So that's really what happened in that 5 to 6%. In the other percentage, the appeal system, there's a problem of discrimination. There, we do have that subconscious bias happening in the appeal system, and there's more work that follow after our work. Some folks try to make an experiment to evaluate the appeal system by an experimental basis, and they find effects that are consistent with what we already have shown. So I want to make that emphasis for two reasons. First, because I think the problem is structural. It's structural racism issue there. And second, because having that structural, that government program, procedure causing the inequalities is exactly the type of evidence that you need to have an FHA disparate impact case. So I think that helps a lot also to satisfy causal requirements that are of practical importance.
Thanks very much. Let's take both the questions.
Actually, I will ask him afterward.
Okay.
Time, so you can-
Okay.
yeah.
Oyebola.
Okay, so my question is maybe the flip side of the previous question, which is, and sorry, I'm backing you because I'm
That's all
facing
right.
the microphone,
Yeah.
which is thinking about the market valuation, because I think that that's where there's a lot more evidence of individual bias. So if you want to buy a house, somebody comes in to actually value the property. And so you've shown us a lot of your talk had focused on the assessment value, like for the tax purposes, which is structural, like you said, it's machine computed. But the market value, I think that's where we hear a lot of evidence of, one person comes to value your house, and whether you put white people's pictures on the walls versus you put your black family on the wall, the valuation changes. So I feel like I'm wondering if any of that is reflected in your results.
Exactly. So there's three ways of thinking about property values. You have the market value, you have the assessment, which is the public valuation of a home, and you have the appraisals, which are the private valuation of a home. When we see assessments are routinely too high for minorities, appraisals are too low for minorities, and then that has a lot of problems on the credit side. The market is about right with a small higher premium for black folks and the minority folks, but it won't change this result. If anything, it will make this result a little bit small, but just not by that much. But a caveat on that is like even market values are a little bit higher for black folks than for whites. Those are within race transactions, most of them. So black people selling to black people and white selling to white, especially the black to black. So that premium is not actually coming from a transfer on the other two. But the comment about the photos is mostly a big problem in the appraisal of that. So you have like the worst of both worlds. You have assessments that are too high and appraisals that are too low. So.
Thank you very much. Thank you, Carlos.
Correct.
Thanks a lot. So let's move on to the next. Yes, please. We move on to the next presentation. Rachel is a professor of economics at Imperial College Business School in the Department of Economics and Public Policy. And she's also a research fellow at the Center for Economic Policy Research and the Institute of Labor Economics, and a theme leader for the structural transformation and economic growth. She holds a PhD in economics from the University of Pennsylvania, and her research interests span the theory of economic growth, labor markets, and housing markets, focusing on structural transformation, time allocation across skills, gender, and across countries, the role of surge frictions in housing markets, and the Chinese economy. That's a lot of different and diverse interests and areas of specialization. Over to you. Rachel.
Thank you. And they're all fine in this conference. Yes. So thank you very much for including this paper for the conference. So it really go back to, the introductory speech is we wanted to look at the, it's in the government review now. So there's a growing concern about transaction tax. Now that's a very big item of government tax revenue, and in some country, it actually is a very active fiscal tool. Like, in the UK, various time, COVID, or they want to stimulate the economy, or they want to cool down the economy, there's always something done to the transaction tax. Okay, so it's something being used a lot, and it's quite important for government. But recently, there was growing concern among the policymaker that this is something that might not be a good thing. It might not be efficient. In fact, I go back to your point that they were actually suggesting, both the Henry Review and the Merley Review for the UK, they're suggesting that we should replace the transaction tax with property tax, okay? Which I will show you a little exercise at the end. If we replace the transaction tax, we raise the same tax revenue with property tax, what do we achieve? So that will come toward the end. So there has been a large literature, but mostly for rich country, as we mentioned. So I'm going to, time is very limited, so I'm going to give you the big picture of the paper. There are many links, so you can get the slide, you can press on the link and find out the detail. So what do we think is the contribution of this paper is the following. So most of the literature have looked at when I increase transaction tax. Here would be like transfer tax. In some country we call the stamp duty. So basically when it's like the sales tax you mentioned, it's easy to implement because anyone who wants to buy, you have to pay that tax. It's very easy. You don't have to assess anything. Everything come out automatically with your transaction price. So the first thing we wanted to do is, in the literature, people only look at the impact of that on the ownership market. So they say when you increase transaction tax, there will be less transaction and house price will be lower. And the main contribution of our paper is to show both empirically and theoretically, when you change the transaction tax, you don't just change the outcome in the ownership market. You actually change the outcome in the rental market as well. Okay, so that's the main contribution. Now, research is always like that. Ex ante, it sounds surprising. Nobody talk about it. Ex post, you thought it's so obvious because people have to live. They either own or they rent. So if it's harder to own now, they have to go to rent. And when people go to rent, it increases the demand for the rental market. So therefore, this linkage is exposed very intuitive. But so the paper has three parts. The first part is a very interesting empirical session, okay, which I will show you very briefly. Then the second part is the search model, as I mentioned, as was mentioned earlier on. That's one of my main research interests as well. And the last part is to quantify and to talk about the welfare cost and compare to the property tax. So I'll be very quick. So the way we try to establish empirically, when you change the transaction tax, you don't just affect the ownership market, you actually also affect the rental market. It's with a very interesting event. So there's in the city of Toronto, okay, so the data we have is from the Greater Toronto area from 2000 to 2018. And most importantly, we can match when a transaction happens, we know whether they buy it to live in it or they buy it to let it out. So we merge the sales data with the rental data, okay, by looking at the address, okay? If it's purchased and then within a year it was listed on the rental market, then we say that transaction was by an investor who bought it to let it out, okay? So that is the key innovation here. And so what is happening? So with that, you constructed the data, okay? With all the transactions, we separate into that is buy to live, buy to rent, and buy to sell. So that's all these different kind of transactions. Then what do we do? So in 2008, the city of Toronto, they actually suffer from some budget crisis. You know, They need money to garbage collector and etc. But instead of changing the property tax, they decided to raise the transaction tax. Okay? And that gives us a very nice setting. So basically, the border of Toronto, which is there southwest, the way you look at it, if you're within the Toronto border and you try to buy houses, you have to pay higher tax. Whereas if you are outside the border, it didn't change. So that gives you this continuity within the border and outside the border. And then before the change and after the change. So that's where the empirical identification is coming from. And then, of course, there are various ways you can do it. You can look at 3 kilometer between cross outside 5 kilometer. You can also think about anticipation effects. Maybe it was somehow anticipated, so we can exclude transactions that happen within a month and beyond. You can have different city pattern over time. Maybe Toronto City have a city-specific housing demand over time. So all this will be in the empirical study, which I'm not going to show the regression table because there's no time. So there's a lot of specification being considered. Anticipation effect, city time trend, and substitution just within and outside the border, okay? So with all this, I come to just this one conclusion about empirically. You can click on the table and look at all the regression. So the interesting fact is the following. When a transaction happens, they pay more tax. So effectively, the tax increased from 1.5% to 2.8%. Okay, that's the effective increase. But, so whether you're an investor or you buy to live, you both have to pay more tax. What is interesting is, what we find is, there are more people buy to invest, but there's less people buy to live. So there's a differential impact, even though they pay the same tax. So that's the beauty of it, because the previous literature only look at total transaction. They say total transaction come down. But what we say is, total transaction come down mainly because a lot of homeowners decided to buy less. Investor actually now buy more, even though they pay more tax. So this is where the general equilibrium is very important. Because otherwise, if you only look at the direct impact of tax, they pay more tax, why should they buy more? Because this is the first result. Buy to own, go down. Buy to rent, go up. And there's much more activity in the rental market, okay? So the lease to sales ratio really went up, and price to rent ratio went down. So that means relatively, the rent is more expensive compared to the price, because price really come down. And then within ownership market, we find impact. The first one confirm what the other people find, which is people stay in their house longer. Basically, there's less mobility. Because every time you move, you have to pay the transaction tax. Okay, so this is also found by other people. What is new is the second one. It also takes longer to buy. That's very interesting. And again, you can only think about that if you think about equilibrium. Because if you foresee you're going to stay in this house longer, you better not find something that you really like. You don't want to find something so marginal, and then very soon you have to move again. So this is the search friction that is coming on. You are trying to find a good match in the market. That match has to be good enough that you can stay in it longer. Otherwise, you have to pay the tax again. Okay? So this second effect within the home ownership market is also new to this paper. Okay? So that is our empirical contribution. So then let me go to the model. Okay? I'm not going to show you any equation, obviously, with time. I don't even know how much time I spent already. So it is a very, so I've been working on search in the housing market for many years. It's very personal, because when I buy my first property, I realize, it is really almost like finding a job or finding a husband. It's very difficult. You don't just go and say, okay, I buy this one. You look and look, you look for many. And what is most important is, okay, the search friction that I want to highlight, which is the second one. So the first one is just that it takes time to find something. Okay, but nowadays, with the internet, it's much easier. I go to one of these rightmove.com, I enter all the criteria, and there's a list of property. But they're not the same to you. You want to go for viewing. Very few people will buy a property without viewing. And what is special about viewing? Special about viewing is if you and I, me and Carlos, go to see the same property, he might like it a lot because it has a shed, for example. And I might not like it. But there could be another property, I like it a lot because there's a walk-in wardrobe. And he will not like it. So this is the match quality. It's very specific to the buyer and the house. Okay? And that is what would explain what I find empirically, that there will be an increase in the time to sell. So that's the core of the search model. So I wouldn't have time to do all this, but basically it's a very complete model that will give you a lot of these outcomes, okay? So I'm going to, and then you have investor, so there will be two markets. So there will be a rental market, there will be an ownership market, okay? So people, okay, I shouldn't have, the last bullet is basically every person who come into the city, they will have to decide, should I buy or should I rent? And the reason they can afford to buy is they can get a mortgage. So that's some sort of credit score, okay? So people can be different. So that gives you the equilibrium number of home ownership, okay? So that would be how the market works. There's a rental market and there's an ownership market, and there will be free entry of investors. So that K is like the value function of the investor. They come in to clear the market, to supply rental property to people. Okay, so that is the full equilibrium, and there are many, many Bellman equations there if you want to go into that. So let me just spend 2 minutes to tell you the intuition and then give you the welfare results, okay? So how do we generate those empirical results? So think about following. When you increase transaction tax, there's the household behavior. So now to be a homeowner, every time when I think about moving, I have to pay more. The first time I go in, I have to pay tax more. And in the future, I also have to pay more. So there's less incentive to become a homeowner. So therefore, that credit cost you pay has to be lower, okay? It makes you less likely to go into the ownership market. And they also become more tolerant, okay? Because they know that every time they move, they will have to pay that tax. So they stay in their house longer. And if you are staying in longer, you become pickier, okay? And that explains the increase in time to buy. So that is telling you the homeowner's behavior. And what about investor? The direct effect, as I mentioned, they pay more tax. So therefore, they want to cut down their transaction. But there's an equilibrium effect, because now there are more people wanted to be a renter. That increases the demand for rental property. And that will attract the investor to come in. So therefore, the model can explain why there's more investor transaction. Okay, so let me just go to the last bit about the welfare effect, okay? So, because I don't want to take too much time of other people. So the welfare effect is huge, much bigger than what the literature finds. So what is this number? So this is a typical way the public finance will calculate it, to say for every dollar you raise as revenue, what is the loss in this economy? And the number is 113, okay? So it's a huge welfare loss. And where did it come from? More than half is coming from this across market. Because now people who were supposed to be homeowner, they stay in the rental market. They were not coming into the rental market. Okay, so that is the huge cost. And then here is an exercise where we do for the property tax. Okay, so what I call consumption tax is property tax. Okay, because it's basically and property tax here is like the way in reality government tax it, and then we basically give back to the local residents as services. So as you can see, the impact of the welfare loss is hugely different. One is 113, and the other one, actually, there's a tiny bit of improvement. So basically, since whatever you do, you have to pay it. It's independent of your decision. So therefore, it has the least distortion. Okay, so this is the comparison of the property tax and the transaction tax. So let me click it back. So let me now conclude. I am sorry that it was so quick, and then now I lost my thing. You see how many things you can go and chat later. So here's the summary. So I hope it gives you an idea why government now is seriously. So we were actually contacted by the New Zealand government about this paper because they are considering replacing the stamp duty with the property tax. Yeah, so this is something that is quite, we think is very important. First, it's a big source of government revenue, and they needed to provide services like the property tax that you look at. It is really just to, a big chunk of it is to provide local services. So, we think that it will be a good suggestion to replace it because it's quite unnecessary to induce so much distortion in behavior. Okay, so let me stop here. I hope I didn't take too much time.
Thank you. Thank you very much, Rachel. In fact, I mean, you didn't have the time to share so many of your slides. I'm sure there's a lot of really interesting stuff in there.
Yeah, you can all click. There's lots of there.
So one of the things that I wanted to pick your brain on is whether you looked also at the impact of the higher transaction tax on the job market or the flexibility that individuals have in terms of moving. Because I know that, for example, someone from Belgium told me how for them, the very high transaction taxes are actually a disincentive to move. So the stickiness of staying in a home longer may also have other negative welfare impacts. So that's just a quick observation. I don't know if you have a quick comment on that.
Well, it's definitely so. In the labor literature, people often use home ownership as a proxy of mobility cost. So here, as you can see, higher tax really reduced the mobility. So it is a very important. It's just that we didn't specifically look at the employment outcome and stuff like that. But it is an important channel. Yeah. So the cost could be even bigger if you think of that as a matching of jobs and worker. That could be even bigger. Yeah.
Thank you. Questions? Carlos?
Yes, very interesting paper. I was thinking.
Maybe can you?
Left corner. Yeah.
Yes, I was thinking, how does this compare, for example, to having a property tax system where you reset the property taxes upon resale, which is, for example, in California, that's the case. You have a property, in many places you just constantly reassess, but in some places you don't. So that would be more or less equivalent to a transaction tax. So I was wondering if you have...
because that is conditional on transaction. So that was precise. There's this, what's it called, Proposition 13, wasn't it? Yeah, so there are a literature on that, and that is really, with that purpose, then the property tax is like the transaction tax because you get reevaluated when you carry it out. Whereas, we should just, it's like your last line of your slide. The simplest way is just link to the local house price index. Why do you should put some subjective value to that assessment and everything? Yeah. But as you say, it could be historical reason is there and it hasn't been changed. Yeah. But it's a good observation. Yeah.
We have one question there. Please also introduce yourself briefly.
Alessandro Toppeta, Stockholm University. A very interesting talk. I was wondering, to what extent Airbnb or other services like that are going to play a role with renting and people buying just to rent their property for short periods.
Yeah, I guess the Airbnb will be try to smooth it in the sense that you will just rent it out and then you can move. So it will sort of smooth that mobility issue a bit. Yeah. Yeah.
Hi, Enid Slack, University of Toronto. I'm familiar with the other studies done on land transfer taxes or stamp duties using the Toronto data, and these are some interesting extensions that you've put on. The reason the City of Toronto brought in the land transfer tax in the early 2000s was the provincial government passed legislation that allowed them to do that. None of the surrounding municipalities were allowed to do it, by the way. only Toronto, and They have asked for that right, but have not received it. They did use it for many years to help them keep property taxes low, even though the property tax is a much better tax than this one for many of the reasons you've given. But, you know, it's a very volatile tax. And so they were using it in the same way as they were using property taxes to meet operating expenditures. But then when the market changed and those revenues started to go down, they were in a bit of trouble. So there's that added problem of a land transfer tax that has to do with volatility that you don't see with the property tax. So I just add that comment.
Yeah, no, indeed. So this is the paper of the Toronto paper that you have in mind, right? Yeah. So compared to that paper, the key thing is the cross-market margin and the time on the market, as I mentioned. But you're completely right that, you know, it is, for me, I think maybe politically, so when I was reading the literature, people were saying politically it's actually harder to increase property tax because everybody pay. Whereas if you increase transaction tax, it has this sort of feeling that, only those who are buying, who are rich enough to buy or want to move, they are suffering from it. So there's a feeling there that it was for that reason why sometimes government just find it more easy to change the transaction tax. Like in the UK, over the last few years, it changed many times. They give break and then they remove the break and then they do this. Yeah, it is quite a volatile thing.
Also, there's an issue of accountability because it's a much, you know, the tax that you're paying every year, the government has to be accountable for that. A one-off doesn't have the same kind of accountability.
So I think it's the implementation part. Yeah.
One of the criticisms that I recall of that paper was that it didn't differentiate between condominiums and single-family homes.
We have done it separately. So the results I show you was for single-family home.
Yeah. Okay. Yeah. Thank you.
Thanks very much. Liwa, one more question, and I think this will be the last one for this session.
Yeah, thank you very much. So quite fascinating. So my conclusion is that from a policy standpoint, all taxes, whether it's property tax or it's transaction tax, is effectively a tax on the occupants. But what I need you to clarify for me is one of your conclusions that because transaction taxes alter preferences as to whether you want to own to live or you want to buy to rent. The conclusion is you said it increases demand for rent. And I'm thinking, if I want to buy to live, so both the supply and the demand is taken away from the market. If I choose not to buy to live but to rent, then the supply and the demand is in the market. Isn't that a zero-sum game?
So yeah, I guess I rushed very fast. So here the key distortion because it's the behavior. Okay, so let's say the distribution of credit cost is given. Okay, so some of us have a better credit scoring, and therefore we can assess the mortgage market. We can buy to own, and some of us haven't got that good credit scoring yet, so we are renting. Okay, so this is given. So in the presence of this, we are saying that without the tax, I would prefer to be an owner, but because of the tax, I'm basically pushed out from the ownership market and put into the rental market. So that's where the welfare cost is. In the absence of the transaction tax, I would have been in the ownership market. But because this tax go up, so now I need to have even lower credit score to justify that for me to go into the rental market. So that is the behavioral part that is important, and that is kind of the distortion, yeah. So it's quite like many other tax incidents. When you change the marginal benefits and marginal cost, then you generate a wedge, like the standard Harberger triangle. But here we are, seeing it in a more richer, dynamic context, yeah.
Thank you very much. Thanks, Rachel.
Okay, thank you.
Of course, in the US, there's the other big fixed charge for sellers, which is the Realtors Commission, which has a huge impact on home mobility. But anyway, moving on to what I think is going to be another very, very interesting paper from Oyebola Okunogbe, who's an economist in the Human Development team of the World Bank's Development Research Group. Her research interests are in governance and political economy, public finance, nation building, education, employment, and gender, all lots of really, really important issues. She got her PhD in public policy and her MPID from Harvard, and her BA in economics from Dartmouth College. So over to you, Oyebola.
Thank you, Rajul, and thank you everyone for being here and for all the great discussion so far. Today we're going to be going to another continent, I feel like it's a big jump mentally that we have to do now, because we're going to a very different setting. We're going to Monrovia in Liberia, where tax capacity is much lower than the scenarios we've been discussing so far. And I'm trying to use this talk to help us to think more broadly about what are the challenges that low and middle income countries face in administering taxes, especially something like the property tax. So, no need to rehash some of the introduction we've been given already, that low and middle income countries collect less revenues in general as a share of GDP, and similarly for the property taxes, this is a much less underutilized tax. Now the question is why, and I'm going to be pointing to tax capacity as something that's different and lacking. And the thing about it, to collect taxes, there are 3 dimensions of tax capacity that governments need to acquire. The first one is what I'm calling identification capacity. You need to be able to identify the tax base. And to do this, you need things like digital registries, like databases to know who the taxpayers are and what the tax, for instance, in the case of property, what are the properties that even should be taxed. And you might imagine this is more difficult in settings where there's a very large informal economy. Now, even after you've identified what the tax base is and who the taxpayers are, the next thing is what I'm going to call detection capacity, which is that you now need to be able to verify the tax liability. You can think of this in other taxes like VAT or corporate income. You need to know how much people are earning. You need to know how much revenues they're making, what their profits are. But in the case of property, you need to be able to value the property so you know what the liability is. And third, after you've found the tax base, you've gotten the true liability that's owed, you need to then be able to enforce the tax laws and actually collect these taxes that are owed. And this is what I'm going to call enforcement capacity, which means, and this is really important because you find that majority of unpaid liabilities, they just go uncollected for several years in a wide range of countries. And this capacity includes things like having delinquent notices, penalties, and interest that are imposed, garnishing wages, sanctions, and prosecution. And in this paper, what I'm going to be trying to do is to distinguish these different dimensions of capacity and show them at play in a specific setting. But first, I just want to convince you that it's important to do this for a few reasons. So the first one is that many times I think we are operating with the mindset of the context in which many of these tax models are developed. You know, we take a Hanliam-Sandmo model and we just think of them in the same lower-income country context, which doesn't work. Because first of all, many countries this identification capacity is lacking. You know, in Africa, 45% of people have no form of government-issued ID. So in those settings, being able to first really focus on that this identification is a problem to be solved on its own, and the government needs to invest the right amount of capacity in doing that is really important. The detection capacity is one that's well studied. There's a lot of literature on how, you know, it's important to get third-party information. If people are selling, you need to get information from their buyers as well. If people are employed, you need to get information from their employers as well. So that one, I think there's a lot of work on that. But then on the enforcement, we often just also assume that this happens. And on the last slide, I just showed you a variety of settings where it doesn't. And very important is that each of these dimensions of capacity requires very distinct types of investment, and the policy responses are very different. And so it's important for every government in each setting to understand what are the binding constraints in my setting to tax collection, and how can I address them to move forward. Okay, so that's what I want you to keep in mind before I dive into what I'm doing in this paper. So in this paper, I'm going to be showing you results from 2 experiments. that are asking the question, what is the impact of increasing citizens' perceptions of the identification capacity of the state, and then separately of the enforcement capacity of the state? I'm going to be answering these questions in the context of real estate taxes in Monrovia, Liberia. And you'll notice that detection capacity is missing. I'm not going to focus on that specifically because in this setting, their main goal was to just bring in people into the tax base. They're like, let's just get them in. The value we can deal with later on down the line. So they had a self-assessment, a self-declaration regime where you just say what you think the value of your property is, with the caveat that the government could purchase it from you at that value. Now, to say a little bit more about tax compliance in Liberia, it is very low. So at the time we're doing this study, only about 5% of residential properties were on the tax roll. And among those that were even on the tax roll, only about 40% of the people who paid 1 year would pay the following year. And this could be linked to deficiencies on these 3 dimensions of capacity. So first of all, there was just no cadastre. And then next, they didn't have any standardized billing procedures. So people had to go and request their tax bill if they really wanted to pay. And I don't know how many of you here pay property taxes, but I don't think I will remember to request my bill if I had to go and ask for it each year. I will conveniently forget. And in terms of the enforcement, there was very little that was being done in terms of court convictions. For the several years that I worked there, I never heard of one person being convicted. The cases would just get stuck in the courts for a very long time. And so what the enforcement looked like in practice were a lot of repeated visits. So they would target the highest valued commercial properties. You go today, you would speak aggressively, you go the next day, you talk calmly, you beg, you threaten, you do whatever you can to convince them to pay over time. And thinking about what the tax rates are, this is about 1.5% of the value of the property for commercial properties and 0.25% on residential property, which are not small rates in general in this literature. It's about a $70 per annum on residential, which is about 2/3 of 1 month of GDP per capita. And they had some payment plans available. So in the first project that we did together, this is the experiment design. There were 461 property owners in one pilot community in the city. And what we did was we divided them into 4 groups randomly, so that in each group, they looked very similar to one another. And what now made the difference was the fact that they got a different kind of notice from the tax authority. So in the first group, there was a control group that just got a simple letter that said, "Dear property owner, we are asking you to come and pay your taxes. These are the procedures on how to pay." So that's just this plain notice. In the first treatment group, here they used the identification information, and I would refer to this in a minute of where this comes from. But essentially, the government goes around first to enumerate all the properties in this area. So they collect the location information, they collect the ownership, they take a picture of the property, they collect all of this information, and then use it to create this notice. So on the notice, it says, "Dear Rachel, Ngai," and it has a picture of your house on it, and it's letting you know that we know that this is your property, and now you know that we know, so pay, please. And then the second treatment, it's told what the legal penalties were for non-compliance. So Carlos, that one did not have your name on it. It was just a plain notice, but then had what the penalties for non-compliance were. And then the third treatment arm had both of these elements, so both the personalized information as well as the legal penalties. And this is the slide that I should ideally have discussed earlier about how they even collected all this data. So this is now almost a decade ago that I worked with the LRA in training their agents in the door-to-door enumeration and to collect all this information. And this was the first time that they had these electronic records and digital photos. And we did this in one community, and over time they expanded. And essentially what we're doing was to make the tax base legible. This is a book by James Scott called Seeing Like a State, that it's one thing to be able to look around you and see like there's so many properties in DC. It's another thing to have them codified and organized in a way where you know exactly what is where. And we had a great example from the Rwanda yesterday about just what the state had to do to codify and to make the tax base, to make the properties legible. And then 2014, Ebola hit. And so, the project went on a hiatus for a long time, and then it was 3 years later that I was able to return and continue the project with them, where they now took these notices that I just described and delivered them to the different property owners. And so this is what the notice looked like. This is the plain one that was sent out, and then here is the box where it had the penalty information, and then this attachment was where it had the owner's name and then the picture of the property for the people who received that treatment. Now, what did we find? The first result is that we see an increase, a 5-fold increase in the likelihood of people making a payment. So the first bar here in gray is in the control group, the people that got the plain notice. Only 2% of them paid this tax. The people that got the identification alone barely changed. The penalty, same thing. It was only in the group that got both the identification and penalty notice together. That's where we see a 5-fold increase in the likelihood of making this tax payment. We can also look at the amount of taxes that they paid. We see here, again, barely nothing collected in this control group, and we see this increasing significantly, over a 10-fold increase in the combined treatment group. Because here we have a lot of zeros, we are not able to detect a statistically significant difference, but in terms of the magnitudes, we see an indefinite increase. Now we can think, okay, maybe they just happened to respond this first year and then nothing happened again. We can look at what happened over time. So in this first, this is the identification and penalty, we see that the increase over the next 4 years, it goes down a little bit, but even up till 2020, we're still seeing a higher likelihood of payment, and we don't see anything for the other two groups. And this was very cost effective. In fact, what was collected in the first year more than covered the cost of enumerating all these properties and delivering these notices. Now, this, on one hand, was a successful intervention. You have a 5-fold increase, but you could also think that what happened to the remaining people that did not even show up after you know that the government knows that you own the property, you've been identified, and then you've been given the information on penalties. We find that this is also consistent with other studies where government gives similar information. Maybe we've detected that the people that, on other taxes, like the amount that you claim to have sold something is different from what people claim they bought it from you. And we see that people do not respond. And in this case, we think it's very unlikely to be explained by illiteracy or not receiving the notice because it was delivered physically by hand. The postal service was not functional, and the literacy rates were quite high. And so the hypothesis that we examine is that it could be that people just had a very low expectation that any penalties would be enforced on them. It's one thing for you to say that, there's these legal things, but, nothing would happen to me. So this next experiment is going to test this. The design here is that the sample is, these are all delinquent property owners. They're people who have paid at least once in the past, but are no longer paying. And the government wanted to focus on this sample because they said for the new taxpayers, they didn't want that to be the first approach to them with this type of heavy-handed enforcement intervention. So in the control arm, their own notice was very similar to the combined treatment from the previous experiment, in that they received a request to pay. It had information on what penalties were, and it also had the picture, and it was personalized in that way. For the treatment arm here, what was new is that there was an additional text in their letter that said that they had been selected for intensive follow-up. And if they did not respond, then the LRA will proceed to the next stage of enforcement actions. So yes, there's like millions of property in the city, but we have shortlisted, and you're next up if you don't respond, just as a way of really increasing this salience of this likelihood, increasing this likelihood of perceived enforcement. So it's a very similar process where they had to track the locations of these properties because the existing database was just very weak. There was, addresses like John Smith by the Catholic Hospital, and all of this had to now be digitized. And then the notices were delivered. And here, this is what we find. We find an increase from this additional enforcement notice. So we see in the control group here, 23% of people responded at all to this notice. This goes up to 31. 20% of people in the control group make a payment. It goes up to 27%. percent with the enforcement notice. And then the amount paid also increases from about close to $70 to $113. Here, we do not see a persistent impact because after the first year, which was 2019, in the following year, nothing, these are the results. These are regression results, but all of this goes to zero by the following year. And I think this is because we don't see any evidence of the government really following through on this enforcement action. So they're not able to share any specific data on what actions were taken, other than that, the fact that they did try, but nobody was actually forced to pay in this group. And so just for time, let me wrap up what we've seen so far. So what we've seen in this in these two studies are that, yes, when you increase the perceived probability of identification in the minds of taxpayers of the government identifying them, this does increase their tax compliance only when it's coupled with information on penalties. So simply knowing that you're known to the government, that's not enough to shift people's behavior. And I think this is important because there's a lot of emphasis these days on identification, so like registering. We need to register taxpayers. We need to register. But if you register and you have a big database, but you don't do anything with that information, and you're not able to enforce taxes, then you might not actually get the returns that you're hoping for. And another important application there is that when we're thinking of what the binding constraint is, in many cases, I would argue that we now have enough technological innovations. There's a lot of even since I was doing this project, there's so much now that registration, identification, even detection to an extent, those things are really not the binding constraint anymore. Many times, it's after you have all this information, what are you able to do with it? And many times that goes outside the purview of the tax administration itself. It has to do with courts, it has to do with legal systems, and it has to do with other things which can be more challenging for a tax administration to accomplish, including political capital, which we discussed yesterday. Now, in my last minute, I just wanted to make a big plug for this type of research. So all of this was made possible because of great cooperation that I had with the Liberia Revenue Authority. This type of data sharing, it's only when the government is willing to work with you to say, okay, this is the interventions we're thinking about, and you get the benefit of researchers being able to contribute their time, pro bono. If you ask McKinsey or someone to do this, they will charge you an arm and a leg. But to be able to work hand in hand with the staff of the tax authority in really designing these types of interventions, or even in just analyzing the data they already have. And so it's very exciting moment at the World Bank because we're coming together as one World Bank. So from the unit that I sit in, the research group, but then other parts of the bank, coming together to be able to really harness this power of electronic tax data for research and policy. So we've had so far people doing this individually one-on-one with country government, but now together we're coming together to say, how can we get embedded in research projects and really think through questions that tax authorities have, and especially to try and do this research together to be able to transfer technical knowledge and expertise, because many times authorities have this data, but really there's limitations in how well they can use it. So we're really hoping, I'm very excited. And so if there, I know we do have some country government counterparts in the room. We look forward very much to partner with many of you to be able to do joint research together using the power that's available with all the new electronic data that's available now. Thank you.
Thanks, Oyebola. That's a really impassioned plea, so please do respond. I think we just have time for one question because we gave some extra time to Oyebola to make her pitch. So any question on, yes, please. Please introduce yourself quickly as well.
Good afternoon. I'm Carlies Knudsen, the Chief Registrar of Deeds in South Africa. I would just like to ask you, because you indicated that your research was in the informal sector and you did some door-to-door visits, etc. From those who did not respond in paying tax in the end, did you not find any resistance that they see that taxation is a form of disposition of land by government? I'm just asking, because that is something that we experience. Thank you.
Not in this case. It was not a major thing that came up. Yeah. I think that was a short answer. So maybe we'll take one more question. Well, I would take. That was a short answer. Yeah, we'll take.
Yeah, I think since the response was short, I thought I could use the opportunity. All right, so one quick comment and then one question. So one of the states in Nigeria, by the way, Nigeria is at 0.3% to GDP, so one of the lowest in the world. Based on some of the work that the World Bank has done, one of the states in Nigeria, Ondo State, came up with a very innovative idea as to how to do this. One thing they did was to assign different areas to people they call account managers, so they monitor them. And then once people are not paying, they just found that the threat of taking them to court, I think they set up like a land tribunal, improved the compliance by more than 90% because people are not prepared to go through the court process. And then I thought that might be, we're still going to keep the data for another maybe few years. But the question I have for you is this. I like the idea of including the picture, the image of the property in the assessment. But from your experience while doing that research, did you see the risk of, if you don't have the integrity of data and you put the wrong picture, does that then work the opposite of what was intended?
Yeah, no, thank you. I think the process, so that's really why there's a lot of ground truthing and rechecking and checking of what the accuracy of the data is. And so what we had here was, there was the team that collected, and then there was another team that really was trying to verify. And so, for instance, in the second experiment, where people were sent out, there was a lot of emphasis put on being able to verify this. Now, I don't have a lot of actual data to show you on the impact of this on the tax payments, because all that I'm able to see, and I should have shown that to you, is data on people that paid or did not pay. And so this intermediate step, I think you're right that it's a risk, but I think that it's a risk that can be managed by verifying the quality of the data. I think so. And I was just thinking, further thoughts on the first question. There wasn't any explicit risk of dispossession here. I think the closest I can think of is that there is something that was said a lot verbally about how if you are not paying taxes consistently on the property, then if somebody else is paying taxes on this property, then it could be that if there was a legal dispute, you might lose out on it. But this was more of messaging on the part of the tax administration as opposed to complaints on the part of the people. But thank you all for the questions.
Thanks very much, Oyebola. We move on to Arthur Braganca. Arthur, are you, I think we did see you earlier. So are you able to share your slides?
Yeah, let me share my presentation.
That'll be wonderful. So Arthur is a senior economist at the World Bank and works with the Sustainable Development Practice Group. Before joining the bank, he was head of policy evaluation at the Climate Policy Initiative and a lecturer at PUC Rio. His interests lie at the intersection of environmental development and public economics, and he has been published in peer-reviewed journals such as Proceedings of the National Academy of Sciences and Journal of Public Economics. So over to you, Arthur.
So thanks a lot. Thanks for the invitation to present. I'm sorry I wasn't able to fly to DC. Had a medical emergency in my family. But anyway, it's good to be here anyway, and excited to hear your comments on this paper. So I'm going to switch continents again, and now switching from cities to rural areas, and I'm going to talk about decentralization of rural land taxes in Brazil. This is joint work with a lot of colleagues from different institutions, and our high-level motivation, it's very similar to what Arturo mentioned in the beginning of the talk. Low-income countries, low and middle-income countries have a hard time taxing property, and actually like they don't tax as high-income countries in general, but they face particularly large problems to tax a property. So the big question is like what we can do like to help those countries to tax property more if they want it. And this is kind of relatively simple paper in which we look at a tool that's often used to improve government performance in multiple dimensions, which is decentralization. It's like every tool, not a silver bullet. So there are a lot of trade-offs between like local governments having more information about taxpayers, about demand for public goods, so on and so forth, but being more likely to be captured by vested interests. But like what's interesting is that that's not a lot of literature about like how decentralization affects the collection of property taxes, and in particular of rural land taxes. So what we do in this paper is basically like we look at the reform in Brazil that decentralized the collection of the administration of rural land taxes in Brazil. And it's an interesting reform. It was enacted in 2008, and it basically like it didn't mandate decentralization. It authorized decentralization to happen. So for decentralization to actually happen, the municipalities, which is like local governments in Brazil, have to go to the Federal Revenue Service, sign an agreement, and implement a decentralization program. And what that basically means is that, like, at the same time in Brazil, so since this reform, you have places in which the collection of these rural land taxes it's decentralized, in places in which the collection of these rural land taxes is centralized. And what we do in the paper is basically to explore this variation to try to answer two questions. And the first is like, did decentralization actually influence the revenues from this tax, which is called ITR? And the second is, okay, if it had an influence, so how it influenced? So how did taxpayers react to this, the decentralization? So, and here we are interested in two types of behavioral responses. One is like the feeling behavior. So are they feeling taxes different? What they are doing different? There are more taxpayers feeling taxes. They are changing like what they report. And the second is whether there's like some changes in kind of like real world decisions like investment and behavior and so on and so forth. So before like I move to the empirics and the results, let me explain a little bit more in more detail like the context of this. So this rural land taxes in Brazil, ITR, was created in the 60s, and it's administered by the Federal Revenue Service, which is basically like the government body that runs like personal income taxes, other types of taxes in Brazil since the 1990s. And this tax has three components. So it's basically the product of three things. One is the land value. So what's the value of the land in that property? Not the full value of the property, but the value of the land. The second is the taxable area, which is what the share of that property that could be used for agricultural activities. So it's basically like the area excluding native vegetation, water bodies, and really steep hills. And then there's a tax rate, which is kind of a non-linear function that depends, like it's increasing on the size of the property, but it's decreasing on how intensively it's used. But the key thing about this tax is that all the parameters that are relevant to determine like the final value of the tax, they are self-reported. So the land values are self-reported, the size is self-reported, the land use is self-reported, which basically means that if you calculate the effective tax rates, although that by law, like the minimum tax rate is 0.3%, the effective tax rate is like, it's less than 0.1%, between 0.05% and 0.1%. So just to give you an idea, like Brazil exports like probably more than $150 billion in agricultural products per year, and it collects less than $1 billion in rural land taxes. And this is like this is likely due to like a lot of misreporting. So people are misreporting this tax in multiple margins, and nothing happens because this enforcement is super low. And actually, like when you talk to people from the Brazilian Federal Revenue Service, they say, look, before the decentralization happened, like there were no audits for almost 20 years. So this is the context. And actually, this decentralization reform that was enacted in 2008, it's kind of like trying to tackle this problem. Basically, like the federal government has like two people running this tax for the whole country. So they wanted to use a little bit like the local governments to help them to collect these taxes. This was allowed by a constitutional amendment in 2003, but it was only regulated by this Decree 643 in 2008. And what this decree basically did was to say, look, now the municipalities can go to the federal government and they can sign these decentralization agreements. In these agreements, basically municipalities, they commit to collect information and to do enforcement activities on behalf of the federal government. And in exchange of their share of the revenues is going to increase from 50% to 100% of the tax revenues. The reform wasn't full decentralization. It's partial decentralization in the sense that it kept with the federal government, with the Federal Revenue Service, like responsibility for screening the properties, imposing fines, and so on and so forth. So basically, like this continues to be a federal tax. So in the ultimate scenario, if you're audited and the government is going to sue you, it's the federal government that's going to sue you. And that was done exactly to limit like the scope for capture of these local governments. So, and then what we do here is like we evaluate the effects of this tax, taking advantage of the fact that we observe the universe, the microdata, the universe of tax returns for the last 25 years. So we have roughly like 5 million properties filing taxes every year. And for all, so we have like about 120 million observations in our data set in which we observed like tax due, tax paid, delays in payments, land values and land use area, tax rates. Of course, like all these things, land values, land use area is self-reported. The other is like it's actually the admin information. We also use other sources of data on municipal finances, public employees, and land covered by category. So like cropland, pasture land, forest, etc. And then to evaluate this policy, like we have like two challenges. One is like that municipalities, they choose whether to enter in this decentralization program or not. And the second is that they enter the program in different periods. So like you can't simply use like real two-way effects panel regressions to evaluate this. So what we do is that we actually like we focus on difference between municipalities that both signed agreements. But they signed these agreements in the same year. But one group implemented the agreement, the decentralization program, and the other group did not implement the decentralization program. So we're basically focusing on municipalities that showed interest in the program in the same period. So if there was any shock leading to entry in the program, it was similar shocks probably, but then one group implemented the program, the other group did not implement the program. And actually in our data, like about half of the municipalities that signed the agreements, they don't implement the program. So we have a good control group. That means that for like each year, so each treatment cohort, we observe treatment and control units. So we can implement kind of a dynamic difference and difference design for each of these cohorts. And then to have like the treatment effects of the program, we can pull these effects later on, basically run a regression like this one, which is a kind of a standard event study regression, in which we include like time, period fixed effects, times cohort fixed effects here, that to ensure the comparisons are only between municipalities that signed the agreements in the same period. So, and this avoids all the pitfalls of like the recent difference in difference literature with programs with staggered entry, okay? So just to give you a picture of like how the data looks like. So in 2000, so here, like in the left panel, we are showing like the full sample, so all municipalities that signed agreements in Brazil. And in the right panel, we are showing like the municipalities that actually, like it's our treatment group, they actually implemented the agreements. And so 3 things are important here. The first one is that like, once you had the reform, you had like a first wave of like more than 1,000 municipalities. I don't know if it's too small, but it's like 1,268 properties entered the program, signed agreements in 2009, and about like half of them, 638, actually implemented the agreement. So it was a big wave, initial wave of municipalities that entered the program. But then, like, because like Brazil is so big, a lot of municipalities, you have like more than 100 municipalities joining the program each year, at least until 2015. And typically, like half of the municipalities implement the program, half of the municipalities don't implement the program, okay? So, of course, like for the difference in difference, we don't need treatment and control municipalities to be equivalent. We just need them to be moving similarly, like the outcomes, like revenues, tax revenues, and so on and so forth, to be moving similarly before the program. But it's interesting to understand, like, what are the differences in levels between these municipalities. And so the first thing that we see is like treatment and control municipalities, they are actually quite similar in terms of GDP, in number of workers per capita, tax collection. We assess is like services tax, which is the important local tax in Brazil. But actually, like the municipalities that actually implement the program are the ones that had more to gain from the program. So like the ITR revenues, the rural land tax revenues in the year before they joined the program were much higher. And this is actually likely because they have like higher potential to cultivate soybeans, which is the main cash crop nowadays in Brazil. So moving to the results, like our main result of this paper is that when we look at all municipalities and you focus, we see that before the program, treatment and control municipalities, like the revenues from this tax were evolving quite similarly, but then after the program was implemented, the revenues start to grow relatively more in the treatment municipalities, and after 5 years, you have like a 20% increase in revenues. And this is like actually quite robust to different specifications, different estimation methods. We actually, because we have the microdata, we try to see if there's some heterogeneity by size of the property, which is like our prior was that there was going to be some heterogeneity, but we don't find anything. And then we look at by region, and by region, what we basically find is that like central Brazil here, this region is where the effects are stronger, and in the northeast here, it's where the effects are smaller. And then what we do is, okay, we are running this pool, so all treatment cohorts, but we can actually run these effects cohort by cohort to see if they're like the group, if it's the group of municipalities that joined in 2009 or the group of municipalities that joined in 2014, that's driving our results. And what we actually find is that like the effects across different cohorts, they are actually quite similar, okay? And that actually allows us to try to measure effects, to extrapolate a little bit using the data from the early treated cohorts to look into effects over 1 decade. And we find that, like, at least for these earlier treatment cohorts, after 1 decade, like tax revenues from rural land taxes increased more than 40% relative to the control municipalities. We perform like some placebos, so we look at other taxes just to make sure that what we are capturing, other local taxes, just to make sure that what we are capturing is not simply the fact that these municipalities that join this program are like expanding their tax capacity, and we find nothing on these other margins. And then we decompose these effects into margins. First, we decompose on whether it's coming from like the self-reported land values or whether it's coming from the implied effective tax rate from the land use that's reported. And we see that like all the effects are coming from the self-reported land values. And then we actually decompose the effects in the intensive and extensive margin. And we see that although there are some effects in the extensive margin, like when you do the actual decomposition, we find that most of the effects is coming from properties that were already filling taxes. So basically, like the most important behavioral change here in terms of filling behavior is that properties that were already paying this tax, like the taxpayers start reporting much higher land values. And we also test, and this is basically after 2017, what we have is that like the Federal Revenue Service, they collect data on what's the minimum value of the of land values in each municipality. So they collect the data for the municipalities that are not decentralized, and the municipalities report the data for the places in which the tax was decentralized. And what we test here, we wanted to see whether there's bunching at this minimum value, which is this line here, and whether this bunching was differential between denounced municipalities, which are basically the control municipalities, and non-denounced municipalities, which are basically the treatment municipalities. And the idea is that, okay, if what local governments are doing is just to provide better information to the central government, they would basically, like the mayors would go and say, look, these are the new minimum values, everybody would bunch there, and that's it. But if the municipalities are doing more, if they're doing something else, we are not going to see just the bunching. And actually what we find is there's less bunching in treatment municipalities than in control municipalities. So it seems that what's driving the increase in tax collection is not just like better information being provided by these local governments, but they're actually doing some enforcement on the ground. And then finally, we look at other decisions. So we look at land use decisions, which is kind of a proxy for investment behavior in Brazil, in the Brazilian agriculture. And we see no changes at all, either on like the share of the land that's used as pasture, the share of the land that's used for crop cultivation. And even if we break this by different types of crops, we don't see a lot, okay? And well, we do a cost-benefit analysis that I'm going to skip here, but just basically to say, like, if you, like, given the size of the effects and the cost of implementing this policy, like, this is a highly cost-effective program. And it's actually welfare enhancing if you believe that those results on investment behavior or land use imply that the efficiency costs of this policy are kind of small. So, like, just to conclude, so we find that decentralization in land taxation in Brazil, like, increased revenues by 20% in 5 years, 40% in 10 years. And this is actually driven by increases in self-reported land values of existing taxpayers. And we find that this reform, although it seemed to have increased the enforcement and the tax rates, it had low efficiency costs. And I think there are three important implications here. One is that, like, this cooperation between central and local governments can be like an important tool to improve tax administration and improve tax collection. And the second is that although, like, enforcement increased, tax rates increased, efficiency costs were quite low, which is actually different from this really nice paper by Anne Brockemeyer and co-authors on urban land taxes in Mexico City. But two important things here, like, just to put these results in context, is like compliance at the baseline was extremely low. And here we are talking about like a setting in which taxpayers are relatively rich, because small properties in Brazil are kind of exempt of this tax. So we're basically talking about like kind of medium to large landowners. And it's actually interesting that when you talk to tax auditors, what they say is like, when you audit a property that's not paying this tax, the rural land tax correctly, like they basically say, look, you have to pay 3 times more. They go and pay. And that's very different from other taxes in Brazil, because when you go and say, look, you have to pay more personal income taxes, people are going to fight you in court. They're going to be like a very long process. They are going to fight that. In this case, they don't fight. It's actually because the tax is, like, the initial level is low and the liquidity constraints are not very important for these taxpayers. And then a final thing, and it's a policy implication that I think it is important, is that because we find all this evidence that like people are underreporting land values, it might be a good idea to move from self-reported land values to market assessments. Although market assessments are not perfect, and we have seen this in other talks today, and we have like this like think tank in Brazil that has estimated that doing that would more like than double the revenues. But well, thanks a lot. Looking forward to your comments.
Thank you so much, Arthur. I think really very interesting conclusions that you've reached. Floor's open for maybe around 3 questions. There's one here. Okay, why don't you go ahead? Please introduce yourself.
Hi, I'm Bruno Conce from Pompeu Fabra University. I'm curious about like the other half of all of these municipalities that did not show interest in decentralizing it, right? So you exploit this difference between those that signed for and those that implemented. And your map, it seems that those that showed interest are all of this agro-exporting business in the central Brazil. What would explain this other half of the country that does not show interest in collecting more tax revenues? Can be political economy, lobbying? Do you have a hunch for that? Thanks.
Yeah, no, that's actually a great question. I don't have a hunch for that. I know that like the baseline levels of ITR revenues on these places are much lower. So probably there's less to gain for. So maybe like if you're thinking here, like we are estimating treatment effects on the treated, right? ATT. So you're probably like saying like for those municipalities, probably the effects of decentralization would be quite different. I'm not sure if I'm actually not sure if political economy is a big driver, but I know that for a fact that the return of this policy for them would be smaller.
I see. Thanks.
Any other question for Arthur? Okay, very good. I think we've had a fascinating session. Let me just wrap it up with a couple of remarks. So we've looked at very different aspects, ranging from the assessment and the impact of assessments on how assessments are made by race. I think that was a very interesting paper. We looked at the impacts of the transaction tax on so many things. I think we just covered a few in today's paper, but again, very interesting. When we went to Africa, where we looked at the importance of identification, making yourself visible, or making the state, making the taxpayers visible to them, or the impact of that on compliance. And I think there's lots of lessons there for many countries in Africa. And then this very interesting and useful idea about how decentralization of the tax administration function really has an impact on revenues. And I think Arturo touched on that right in the beginning, of how the capacity constraints of local governments really come in the way of being able to effectively implement what seems to be the most natural local government tax, which is the recurrent annual property tax. But really, it is difficult. We see that, and that's one of the reasons why you see the huge disparity in terms of the revenue mobilization numbers in developing low-income countries, and of course, the OECD countries as an average, but also countries like the US and Canada, which are doing remarkably well on that front. I think the property tax can actually be a very equitable tax, but it does, as the papers have shown us, it does depend on the design. I think in the developing country context, a lot matters in terms of whether, for example, the really low value properties are exempt or not. It really matters whether the governments, the local governments, are able to tax those that are occupying the property, even if they're not registered or titled holders. That has a huge impact in terms of the ability to collect. And then it's really important, and actually today, with the accessibility of technology and the affordability of technology, the whole exercise of identification, of being able to capture the property attributes and then use those to systematically and structurally value properties, and then therefore collect a fair amount of tax, that has become more and more easy given the accessibility of technology and the affordability of technology. And I think we from the World Bank side are doing our bit in terms of of working in that direction for developing countries. I think in terms of efficiency, and this is again highlighted by Arthur's paper for local governments, again, it's really the solution really is technology. How well and how effectively can technology be deployed by local governments to be able to mobilize revenues? There are examples, there are interesting examples, for example, from the state of Karnataka in India, where they've created a centralized platform where the urban local governments can implement or administer property tax in terms of being able to send bills electronically. The taxpayers can pay electronically through that platform, and there are other means of follow-up that again that platform can use. So essentially, the local government is only coming in when there's an enforcement action that needs to be done. Otherwise, if there is a natural compliance or a voluntary compliance, technology can actually just handle that. So I think there are various interesting innovations and ideas that are emerging from different parts of the world. And of course, there are many interesting and difficult issues as well, as we learned today from the various papers and presentations. So again, thank you very much to the presenters, Arthur and...
Can I just make one pitch? So I think, I mean, since Oyebola made the pitch for the data taxation, I think one example that could actually be quite useful in setting that or showing that that is possible would be Nigeria. I think we have Taiwo here, who is the chair of the Presidential Commission on, I can't ever remember it, sorry, on fiscal reforms and whatever, I think, but increasing taxation, that's the main point, I think. I think the bank has actually been financing collection of property details in, I think, 26 states. And I think if this could be made available in a way that is de-identified, and can be, and I think, Taiwo, that is something for you and your commission to decide. I think that could set a very useful example to actually get, because I think Nigeria is a big country, it has a lot of heterogeneity across different states, and I think it could be a very good model to actually then use this data to work with different states to see how they can improve their taxation, because definitely, as Oyebola said, I think things have improved a lot since the time when you had to go and collect these things by house-to-house enumeration yourself, I think. And the states, I think the people that have been established in the states, I think, are quite capable of also suggesting things and actually giving useful input to researchers. So I don't know, Taiwo, if that would be a possibility. Very good. So with that, we conclude the session, and we hope that we will have plenty of papers on Nigeria next year to actually present the results from that. Thank you.